Wendy's has 51.7 million shares sold short. That's not a typo. As of the latest reported short interest data, roughly 32.7% of Wendy's public float was shorted. And the weird part is, this is Wendy's, the burger chain, the Frosty Company, the place that somehow became both a fast food restaurant and a Wall Street bets punchline. And now traders are asking a very serious question about a very unserious looking setup. Can Wendy's actually squeeze? Quick disclaimer, I'm not your financial advisor, and this isn't a recommendation to buy, sell, or short Wendy's. I'm looking at the numbers and the short interest setup and giving you my read. A week ago, Wendy's was not exactly the stock you'd expect to hijack the market's attention. It was a beaten down restaurant name. The stock had been trading near multi-year lows. The dividend yield looked huge, which can mean undervalued, but can also mean the market does not believe this is sustainable. And short sellers had piled in. Then the story changed. Wendy's announced that Steve Cirulis would become its new Chief Financial Officer and Chief Strategy Officer, effective June 23, 2026. He previously held these same CFO and strategy roles at Potbelly, and he's also worked with Wendy's CEO Bob Wright before. That matters because traders didn't treat this like a normal CFO change. They treated it like a turnaround signal. And once that headline landed on a stock with this much short interest, the internet did what the internet does. It made it weird. Short interest is basically the amount of stock that traders have borrowed and sold because they're betting the price goes down. If they're right, they buy it back cheaper, return the shares, and keep the difference. If they're wrong, they have a problem. Because to close a short position, you have to buy the stock back. And if a lot of shares are forced to be bought at the same time, that buying can push the stock higher, which creates more losses for other shorts, which forces more buying. That's the squeeze. For Wendy's, the latest market beat data shows 51.6 million shares sold short as of June 15, 2026. That represented 32.7% of the public float. Short interest was up 2.7% from prior report. The other number I care about is days to cover. Market beat had Wendy's at 6.6 days to cover. That means, based on average trading volume, it would take about 6.5 trading days of all shorts to cover. That's not a guarantee of anything, but it does mean that the exit door is not huge. And when everybody is standing near the same exit, small fires become very interesting. Here's the part that makes Wendy's more interesting than just stock goes up because Reddit got bored. The short interest didn't suddenly appear overnight. Back in early 2025, Wendy's short percent of float was much lower. By mid-2025, it was around the low double digits, then it kept climbing. Market Beat's history shows that short interest moving from around 10 to 12% of float in parts of mid-2025 to more than 20% by early 2026, then roughly 30% plus by spring and June. And days to cover also got heavier. In August 2025, days to cover was around 2.6. By April 2026, it was above 6. Then on June 15, it was 6.58. That's a very different setup. A stock with 10% short interest and 2 days to cover is one thing. A familiar consumer brand with 1/3 of the float shorted, a new turnaround CFO, and retail traders yelling "Save Wendy's" is a completely different animal. Not necessarily a better investment, just more explosive. Then Wall Street Bets found it. Yahoo Finance reported that Wendy's soared after a Save Wendy's push, with traders focusing on the combination of a beaten down stock, a familiar brand, and high short interest. Business Insider called Wendy's the market's latest short squeeze and cited short interest about 32% of float. It also reported that retail traders piled into the stock, with Vanda Research data showing one of the biggest retail net buying days for Wendy's since 2012. That part matters. A high short interest stock can sit there doing nothing for months. Shorts don't cover just because a spreadsheet says they should. You need a catalyst. For Wendy's, the catalyst was half real and half ridiculous. The real part is CFO and strategy chief who signals turnaround intent. The ridiculous part, the internet deciding that the burger chain with the red-haired mascot should become the next battleground stock. And honestly, that combination is exactly why meme squeezes are hard to model. They're not purely financial, they're social events with a ticker symbol attached. The bull case for Wendy's squeeze is pretty simple. First, short interest is extremely high. Again, market beat has it at 32.72% of public float as of June 15. Second, days to cover is high enough to matter. 6.6 days is not some tiny number shorts can casually shrug off if volume dries up. Third, Wendy's is not an obscure biotech with no product. People know the brand, people understand the joke, people can form a meme around it in about 4 seconds. Fourth, the stock has been beaten down. Yahoo Finance data showed Wendy's trading far below its 52-week high, and recent quote data had the 52-week range at 6.07 to 12.04. And fifth, this is at least a plausible turnaround story. Steve Cirulis is not just a random finance executive. Wendy's gave him both CFO and Chief Strategy Officer roles. That tells you this is not only about accounting. It's about trying to change the company's direction. If you're a retail trader looking for a short squeeze candidate, that's a tempting mix. High short interest, low expectations, familiar brand, fresh catalyst. It's basically a value stock wearing a meme stock costume. Okay, now I have to argue against the squeeze case. Because the annoying truth is the best squeeze setup usually looks obvious only after the first giant candle. Wendy's already had the big attention spike. Reports cited massive intraday moves, including a surge of more than 25% during the initial retail push, and some coverage described even larger intraday swings. That changes the math. If you bought before the crowd arrived, you were betting on the squeeze. If you buy after the crowd is already posting rocket emojis, you might be the liquidity. That's the part people hate hearing. Short interest data is delayed. The June 15 number tells us what the short base looked like before the biggest retail attention hit. It does not perfectly tell us how many shorts covered during the spike. Some shorts may have already been forced out, some may have added higher, some may be sitting there with bigger losses and clenched teeth. We don't know yet, and that uncertainty matters. The squeeze case is real, but it's not clean anymore. This is where Wendy's gets more interesting than a pure meme stock, because unlike some squeeze names, Wendy's is a real profitable business. Yahoo Finance data showed revenue around $2.19 billion on a trailing 12-month basis, a trailing PE around 10, and a forward dividend yield above 7%. That's not some zero revenue moonshot, but there's a reason shorts are there. Wendy's has leverage. Yahoo Finance listed enterprise value around $5.3 billion compared to the market cap closer to $1.5 billion, which tells you debt is a major part of the story. Total debt to equity was also extremely high in the statistics page. And in restaurants, leverage is not cute. Fast food is competitive. Consumers are price sensitive. Promotions can drive traffic, but they can also pressure margins. And a big dividend yield can look attractive right up until investors start wondering whether the company should be using that cash differently. So the shorts aren't necessarily insane. They may be early, they may be crowded, they may get squeezed, but the bear case is not Wendy's bad because the internet says so. It's more like slow growth restaurant stock, debt-heavy balance sheet, competitive pressure, and a market that has not been rewarding the story. That's a real argument. If Wendy's squeezes again, I don't think it happens because short interest is high. It probably needs one of three things. A fresh retail volume wave, not just people talking about it, actual buying pressure. Especially if volume starts running above average again. A price breakout above the recent spike levels. Shorts can tolerate pain for a while. They start making emotional decisions when the chart breaks levels they thought would hold. Or a real fundamental follow-up from management, something that makes investors believe the new CFO and strategy chief has an actual plan, not just a fancy title. The last one is the most important if you care about anything beyond a trade, because a short squeeze can move a stock for days, a turnaround can move it for years. And that's the real tension with Wendy's right now. Is this a squeeze with a business attached or a business turnaround with a squeeze attached? Those are very different videos. Actually, they're very different stocks. The funniest thing about this Wendy's setup is that the meme might be pointing at something real. Retail traders are obviously attracted to the joke. Wendy's memeable. The brand is familiar, the Wall Street bets connection basically writes itself. But the underlying setup is not fake. The short interest is really high, days to cover really did climb. The stock really was beaten down, and the company really did bring in a CFO with a strategy mandate to a moment when investors wanted a new story. But I don't think the interesting question is Wendy's a meme stock? Clearly, for now, yes. The better question is whether the meme crowd accidentally found a real pressure point. Because if shorts are right, the rally fades and Wendy's goes back to being a struggling leveraged restaurant stock with a funny Twitter account. If shorts are wrong, or even just too crowded, Wendy's doesn't need to become an amazing business overnight. It just needs enough buyers to make the exit door feel small. So here's my take. Wendy's has a legitimate short squeeze setup. The short interest is too high to dismiss, the days to cover trend is ugly for shorts, and the retail crowd has already proven it can move the stock. But I would not pretend this is early anymore. The cleanest part of the trade was probably before anyone started talking about it. From here, the stock needs either another wave of buying, a technical breakout, or real proof that the new strategy leadership can change the business. Otherwise, this can unwind just as stupidly fast as it went up. And that's the perfect Wendy's stock story, honestly. A real company, a real short base, a real catalyst, wrapped in the dumbest possible meme.